Welcome to the Times of Industry show. I have a great show with Mark O'Brien, who's a returning guest, and he's from GoldCore.com. It's a bullion dealership based out of Ireland. And what I love about it is that we can ask Mark on his clientele, on demand, what people are currently buying. And this is very relevant because gold peaked on August 5th, and we're recording this on October 6th. So basically, 2 months since gold hit that beautiful all-time high of about 2070 an ounce, and silver was on a mad rush towards 30. And we've seen a lot of consolidation since then. We've seen a Nasdaq correction since then of about 13%. We've seen the S&P 500 correcting by about 10% since then. So, and now we have President Trump going in and out of the hospital with COVID-19, and quarantines are coming back to Europe and other places around the world. So it's a great time to tune in and ask Mark what's going on behind the scenes with people and what are they buying. So Mark, thank you very much for joining us.
Thank you, Leor. Thanks for having me on again.
Sure. I really love having you on because I like to ask bullion dealers, especially if they're outside of the US, what people are currently buying. Could you, first of all, tell us a little bit about your clientele in terms of like their nationalities? Are people calling you from the U.S., Europe, Asia? Where's the majority of the sales coming from in general, and maybe more interestingly in 2020?
Yeah, well, most of our clients are in the UK and Ireland. That's our base, and we have offices in Dublin and London. But we would have a healthy smattering of clients from all around the world. Next biggest would be the US, obviously English-speaking world, and there's an affinity with Ireland and the UK. So we have a lot of American clients who like us because we allow clients to own gold in the safest way possible, and indeed silver in the safest way possible, which is basically gold is a safe haven asset, but it's only a safe haven if you own it in the safest of ways. So we allow people to own gold in what we believe are the safest vaults in the world, in the safest jurisdictions in the world. And many American clients, we encourage them to take delivery, and we'll ship to their house in the US and take fully insured delivery of their bullion. It's fully insured till they sign for it. But many of them, high net worth clients, don't have too much of it in the house. I mean, it's okay for small amounts, particularly if you feel very secure in your own home. But for larger amounts, particularly for high net worth clients, they like to support it in. Zurich remains the most popular location, both with our clients and indeed with bullion investors internationally. And indeed, Singapore would be the two most favorite locations as well for people to store gold. But there has been, interesting enough, a movement towards, I suppose, repatriation of gold, both by the central banks themselves, the likes of the German Bundesbank took their gold back from the New York Federal Reserve, but also individuals. I think with this pandemic and the lockdowns and the extreme draconian reaction we've seen to lockdowns, a lot of people realize the benefits of actually having gold in country and within a driving distance of where they live, because for periods of time during March, April, there was supply chain issues, and you couldn't actually move bullion around with FedEx or UPS, or indeed some of the providers. So therefore, if you had gold in your house, it was less liquid because it was very hard to get that gold back into what's called the chain of integrity. And it's only when it's in the chain of integrity and verified can we actually pay you, and can we actually can we make a market and buy your bullion back from you and pay you. So it's interesting. There's a move for, as I said, for people to they want to have it in country because if it's in worst case scenarios, it's great having someone say Singapore, but it's good to have someone as well. It's good to have someone in your home. It's just very, very secure in home. But you don't have too much in your own home at the same time because of the risk, but also because of the liquidity, as I said. So anyway, we have record demand. We're near 2011 levels of demand for the last few months. Huge demand as the price particularly went up during the late spring, summer period. Bit of a lull just since the gold price, as you alluded to. We've seen a correction, which was, I think, was long overdue. It's a healthy correction and the consolidation that was needed, and that's a good thing. And basically, yeah, we've seen quite a sharp drop in demand. We've seen a little bit of selling come in, particularly on silver. I think people saw massive gains in silver in a short period of time. Silver was up 50-55% at one stage, and we had some of our clients actually take profits on not all of their silver. Most of our people are buy and hold for the long term. We did have some people say, wow, we've had big gains of silver, let's sell half of the allocation that we have to silver and take profits. little bit of selling on gold, but not as much. And but we're still seeing quite strong demand, not as high as it was, though, obviously in recent months. But September has been a good month, and October has started reasonably well, But there's a little less, so there's a little less greed. I think the motivation early in the year, it's interesting. The motivation was fear about what is this pandemic and the lockdowns going to do to our economy and markets. And then as we got into the summer and the gold silver price went up sharply, we saw a bit of greed coming in, and people were fear of missing out. The price was moving up, and they said we need to buy quick. And more recently, I think the people are buying now. I think it's more about there are people who are asset allocation people, and people who are have allocations and they're adding to allocations. So the man in the street isn't really there as of yet, not in a very significant way. I think that's coming. I think that would be possibly in the next wave that should push prices much higher.
Mark, before I ask you the second question, can I also ask you to put the mic a little bit closer to your?
Far away, is it? Yeah, is that better?
Yeah, just because of your thick Irish accent, I want to make sure that people understand. And then when you move your head a little bit, at least on my end, part of your reply was kind of hard to stay course with. So,
okay,
for our listeners to make sure for the rest of the interview, I want to ask you basically two questions that arose when you replied. Were you around in 2011 or in 2016 when the top happens? Can you compare the August 6th peak to those peaks? Does it feel the same? Does it feel like the end of a cycle, or does it feel like a correction? And then secondly, when people from the UK or from Ireland call GoldCore and purchase bullion, do they talk about the American national debt? Is that the reason? So Americans, obviously, they fear the unsustainable national debt, maybe some sort of a runaway inflation. Is it more of like the same in the UK or in Ireland? What are people fearing? Because some Americans that might listen to this are saying to themselves, well, in Europe, the problem is actually deflation. It's actually slow growth. It's not like in the States where it's the national debt that's the issue. What is like the real fear? And it's interesting for Americans to know what Europeans are going through, and because everyone focuses on America all the time. So if you don't mind taking those two questions.
Yeah, absolutely. Well, I'll answer the second question first. So it depends. Different clients, UK and Ireland, have different motivations for buying. Most of them are concerned about debt in the world in the aggregate. There's a huge global debt bubble, and I think the debt is now, we're over 300 trillion, and I think we're over 300% debt to GDP ratio, which is absolutely unprecedented globally. So the total demand for goods and services in the entire globe in 1 year is about 100 trillion, and now the global debt is about 300 trillion. So most of our clients are worried. Sometimes they're worried about the debt. There's massive debt in the UK. There's massive debt throughout the European Union. Obviously we had the last Eurozone debt crisis and problems with the Italian economy. There's €1 trillion of debt in Italy, the Greeks, the Portuguese, the Spanish, and indeed in Ireland as well. There was basically debt, So, but you're right. A lot of them, not all of them, but many of them would be conscious of the debt in the US and how it's gone to 27 trillion, and that's just the nominal national debt. Obviously, you guys have unfunded liabilities there's different estimates of between 50 trillion and 150 trillion in terms of Medicare, Medicaid, Social Security, and the baby boomers retiring, as we know now. So these liabilities, they're real liabilities, and they're coming due. And basically how they be paid for is just the electronic creation of trillions and trillions of dollars, and the dollar is the reserve currency of the world. So if the dollar is devalued, as I believe it will be in the coming months and years, it's not that gold price is going to go up per se, it's that dollar is going to be devalued. In effect, the dollar is a reserve currency. So all these other currencies are, they trade versus gold, but because we don't have a gold standard, nothing is backing any of these currencies, including the dollar. The euro isn't backed by anything. And in effect, the dollar is the reserve currency of the world. So if the dollar is badly devalued, that will have impacts on other currencies. And ultimately, the US is a major trading partner for many countries in Europe and indeed in the world. America has been voraciously consuming the goods and indeed the services, but primarily the goods of the world for many years now, and we've had quite a strong dollar. So, but what will be needed for our economies is we all need exports for jobs, and therefore no one wants to have a very strong currency, because if you have a very strong currency, then you will lose jobs and you will not be able to export. I think we're likely to see, if the dollar devalues, which I believe it will, we'll see competitive currency devaluations, whereby all currencies are devalued versus hard assets likes of gold and silver. So it's a good question. It is, yeah, that 27 trillion debt, and it's interesting that it hasn't been really a feature of the election campaign and the election debates. It's not really on the radar of many people in terms of the election. It should be that debt is just astronomical. The U.S. budget deficit this year alone is 3 trillion. So, and under Bush 2, so under Shrub, George Bush number 2, the junior, shall we say, W, it went up 1 trillion a year from roughly 1 trillion a year from 2000 to 2008. Then under Obama, it went up roughly 1 trillion a year. It's really interesting, from 2008 to 2016. And now under Trump, was going up roughly 1 trillion a year. And then obviously we had the pandemic, or so-called pandemic, and we had the massive draconian reaction to the lockdowns. And now it's gone up 3 trillion, nearly 4 trillion in the last few months. So yeah. And then your second question is in terms of comparisons with 2011. Don't think there are really comparisons with 2011, because 2011 gold prices had gone up for 11 years, actually 12 years, since 1999. So we'd had a very extenuated bull market for 12 years. We had quite a sharp correction around Lehman Brothers 2008 for a short period of weeks prior to gold resuming the uptrend. Gold was up 2008, 2009, 10, 11, 12. So it was a much longer bull market, and indeed the scale of the percentage of gains, we went from around below $300 in 1999 to up to $1,950. So that was a big move, as I said, from 300 to 1900. Whereas more recently, gold bottomed in 2015 around the 1200 mark, and we went up to went up to over 2000. So it was a much smaller and gradual percentage increase over a shorter time frame. And therefore, I strongly believe that what we are seeing now is just a correction within a longer bull market, and that's because, yeah, I think that we're only beginning to go into a recession now, and I think we're going to have a very, very severe economic global recession, indeed, not just in the US, but globally. And indeed, I think we'll probably be a depression. And I hate that word. The depression word is very depressing, but I do think that given the scale of the debt, and also given the scale of the geopolitical uncertainty that we see in the world today, I think that there's calls from Goldman Sachs and Bank of America and large investment banks for gold at $3,000 per ounce, and I think they're being very conservative. Gold will probably go much higher, and silver will outperform gold, and I think the gold-silver ratio will continue to decrease here.
Mark, when people were buying in 2011, when people were buying silver at 40 and 45 and 49 an ounce, these clients, were they buying large chunks of silver? So that 1,000 ounces at $49 an ounce, or just, around 10 ounces? And what was their frame of mind? Were they looking to flip it? Was that the mentality? Or were they fearful? What was driving that? Because I'm trying to get into their heads back then as to what propelled people to buy silver at 40 or 45 or 49, where people refuse to buy it. Obviously, today the markets are at about half of that, because I've long theorized that if you put gasoline in your car and you drive to your bullion dealer and you feel inflation and you have $300 or $400 in your pocket, and silver's $30, so you can buy 10 ounces, or 40, you buy 7, or 50, you buy 6. It doesn't matter to you. You're already out of the house. You already want to buy silver. If it's 30 or 40 an ounce, really makes no difference to somebody who comes and buys just $300 worth. So to them it's the same. But for people who want to buy 1,000 ounces, obviously spending 30K or 50K is different, and their expectations is different as to what will be the result. When people were calling you basically in 2011, were they buying small amounts and looking to flip them, or were they really fearful of I think back then was the Greece crisis and maybe a double dip recession, all that kind of stuff. And they
Yeah.
were buying, and these were big buyers. These were credit investors, people that with high net worth. What was the silver crowd like? Not gold, but just silver.
Yeah, no, it's a good question. The majority of them they're not about flipping. Because if you're about flipping an asset and making a return, particularly gold and silver, you would tend to buy an ETF, a gold or silver ETF, because that's you can buy that much cheaper and you can flip it, or you might buy gold mining shares or silver mining shares. Whereas our clients are buying actual large silver bars, primarily the 1,000-ounce silver bars. So their motivation is very much, it's protection, it's hedging. You allude to, we had the Eurozone debt crisis and those concerns that the Eurozone might fall apart, that the euro might fall apart. So the majority of people who were buying silver back then were buying it. There were some who were, looking to make a return and looking to make, see capital appreciation with silver. And there was a view amongst many that silver, including ourselves, we actually thought that, silver was at $50 per ounce in 1980. And we thought that given the scale of the supply-demand imbalances and the huge demand we were seeing for silver, that silver should surpass the nominal record high in 1980 at $50 per ounce, and it should potentially go to the inflation-adjusted record high for silver, which was around, back then it was around $140, $150 per ounce. So there was a view, given the scale of the crisis, that silver would continue going higher in price. So there was, it was a combination. I think it was more store of value insurance, but there were some people that thought prices could go higher. They thought there'd be huge volatility, and silver could go, as it has done lately, go from $50 to $25, $30, and you could see a 50% correction. And we actually saw that in 2008 as well. Silver went from nearly $20 just before Lehman Brothers blew up, nearly $10 soon after Lehman Brothers blew up. And everybody said, oh, look, silver's collapsed and the bubble has burst in silver and the economy's going into recession. That shows that silver is not a good safe haven. And subsequently, silver went straight up and was higher in 2009, 2011, 2010, 2011. So it is. The bottom line of silver is it is a hedge. It is a safe haven, like gold. It's just it is more volatile. People need to be wary of that volatility and not over allocate to silver. Silver complements gold. It's a leveraged form of gold in many ways, but you do have to be careful with volatility in silver and not over allocate to it and seek to take profits in silver. I think that's the lesson from 2011 as well. With hindsight, I was on Bloomberg in 2011 and I said that gold had gone parabolic and it looked very overvalued in the short term. And I said that both gold and silver would do a very sharp correction. And I said in a worst case scenario, both assets could fall 50%. But I didn't in my wildest dreams think that was going to happen. But it did happen. And with hindsight, I should have told clients to be more clear, saying, listen, take profits on some of the portfolio. Always maintain that core position in physical gold, physical silver, because they are insurance assets. And in the world of today, we need these hedging and safe haven assets. But I think there is a room when you see massive appreciation in any asset. I think it makes sense to take some profits and consider the exit.
For sure. Actually, I remember vividly that I had my honeymoon was in 2011, and I had sold some silver in order to finance some of the things that me and my wife wanted to do. So I remember selling at about 42 or 43 an ounce for silver, and we still haven't gotten back there. So it was a good choice.
Very good. So your wife was happy.
I want to ask you, Mark. With everything that's happened with COVID-19, for bullion dealers, the mints, are they mostly reopened now? Obviously, the mint in the U.S. was closed. A few of them were closed even. Can you talk a little bit about the supply chain? And we know in that circuit breaker week in March that everything went berserk, basically. That people were saying that there was huge premiums on the physical. If you wanted to buy over the COMEX, silver traded at $11.99 on the COMEX. I remember that. And then if you wanted to buy physical, you had to pay 25 or 30. And the people were talking about what's the best angle. take whether or not to buy on the short term on the ETF, make a profit, or will the physical contract basically to meet the COMAX. So is production back on these mints, and for the next time something happens where there's a big gap between physical and ETFs, what is your lesson from what just happened now?
Yeah, I think things have returned pretty much back to where they were pre-crisis. It was quite extreme what happened, and it was seen across the entire supply chain. And it was just a combination of just absolutely huge increase in demand very suddenly. People got very worried that we're going to see a pandemic may lead to a massive recession. I'm surprised we haven't seen that just yet, but I think it's coming very soon, unfortunately. So that led to a huge increase in demand, and meanwhile, on the supply side, there was issues both from getting the metal from the mining companies into the refineries and into the mints, because the gold has to be shipped around the world and transported via airplanes, primarily from mines in South America, Central America, Africa, Asia, and most of that needs to go into the big refineries, and the biggest refineries in Switzerland. So yeah, for a period of time, the planes weren't moving, so the refineries weren't getting the stock, the unrefined precious metals, and therefore there was a lack of supply particularly on bars, but also with the mints in terms of the coins. And then there was also the refining industry and the mints, like every other company in the world, they had issues in terms of their staff, and they had to be socially isolated. There was quarantines. Some of the staff weren't allowed to leave their houses. These are quite intensive businesses that require staff on site. In a minting facility refinery, it's not something that we done remotely on Zoom and on using technology. These are intensive, production and manufacturing facilities. So yeah, so when they had less staff available, that also impacted the supply side, the mint of coins, the refining of bars. So there was a lot of sensational headlines about a perfect storm, but it was a bit of a perfect storm, because we had a lack of supply and a huge demand, and we were lucky because we're in business since 2003, so for 17 years. We have relationships directly with the biggest governments in the world, the likes of the Perth Mint in Western Australia, and indeed the Royal Mint in the UK. These are two of the biggest mints in the world. And we also have relationships with all the biggest refineries in the world, including the Perth Mint refinery in Australia and the big refineries in Switzerland. And because of those direct relationships that we have with these refineries and mints going back many, many years, we were able to secure supplies. But there was rationing, and we were basically every single day we were acquiring millions and millions of dollars, euros, and pounds worth of coins and bars, and then we were turning it over so quickly, that it was gone by the end of the day, and we'd have to get a new allocation, and that was the same for bullion dealers all around the world. Some bullion dealers actually ran out of stock, and they were selling stuff they didn't have, which you should really do, because there's a risk in doing that, and some of them couldn't get any supply whatsoever because they don't have the direct relationships with the refineries and the mints. So the supply dried up. There was very little available in the secondary market. So yeah, and I think that possibly will happen again if we get another lockdown in the same degree that we're seeing before. I think we might see the same thing as well, particularly if we see the gold and silver price start to move up quite aggressively. I think you'll see another wave of demand come in. So yeah, it's interesting. And the other thing is on the silver side, that if we go into a recession or depression, then silver is a byproduct of base metals, particularly zinc and nickel. And therefore, a lot of those base metal mining companies will actually stop producing the base metals because there'll be less demand from industry in a recession or depression. And therefore, the supply of silver, it's quite inelastic in that regard. The supply of silver could actually fall while you see massive demand. And we're seeing huge demand. You've seen it both in the ETF, but also for coins and the large bars that we primarily deal in. They're called the 1,000-ounce silver bars, So I think it's a bit of a lull in the storm right now, and I think, but potentially in the coming months, I think we might go back into not the same dynamic, but I think potentially a similar dynamic might be seen
Mark, where can people reach out and talk with GoldCore about basically your products, gold, silver products? I assume you have other precious metals as well, and then storage. I know you do storage in Switzerland and in Singapore, two very interesting locations. So, how can people reach out to you, to your staff, and let people know a little bit about your opening hours and everything like that?
You're very good, Leor. Yeah, so basically you can get us on goldcore.com is the website. And you can get me personally on Twitter. It's at Mark T. O'Byrne, and on LinkedIn, Mark O'Byrne. And yeah, on goldcore.com, we do a daily market update, weekly updates. We're on YouTube. We're on all the usual social media channels, and the team are very, very good in there. So any questions at all, feel free to get in touch with me, or indeed the team at GoldCore, and we'll assist you with whatever your precious metals needs are.
Mark, thank you very much for taking the time.
Pleasure, Leor. Thanks for having me on again.